our first speaker for this conference. Rachel Weber is a professor and director of graduate studies in the Urban Planning and Policy Department at the University of Illinois at Chicago, where she teaches courses and conducts research in the fields of economic development, real estate, urban politics, and public finance. She is the co-editor of the Oxford Handbook of Urban Planning, which is a compilation of 40 essays by leading urban scholars. Her latest book, From Boom to Bubble: How Finance Built the New Chicago, was published by the University of Chicago Press and won the Best Book Award from the Urban Affairs Association in 2017. In addition to her academic responsibilities, she has served as an advisor to planning agencies, political candidates, and community organizations on issues related to financial incentives, property taxes, and neighborhood revitalization. She was appointed to then presidential candidate Barack Obama's Urban Policy Committee in 2008, and by Chicago Mayor Rahm Emanuel to the Tax Increment Financing Reform Task Force in 2011. Thank you so much, Rachel. I look forward to your talk as I pass you the microphone.
Thank you, Amalia. I'm gonna try to share my screen here. Great. So I guess I'm first, and I'm a little bit of a guinea pig, so hopefully this will go well. I thank Amalia and Michael, Paul, the rest of the National Council for Preservation Education for this invitation to address you all today. Addressing you all through the screen it's a little strange, but we're all doing our best to get used to it. So yes, my research has skated around the topic of historic preservation for many years, so I'm glad to finally get an opportunity to explore it in more depth with you today. And I'm going to talk about the reasons why I'm going to address sort of the why question in historic preservation. I'm going to talk about the reasons why certain commercial buildings and submarkets with clusters of historic buildings may become vulnerable to disinvestment and demolition. And as Amalia mentioned, I wrote a book a couple of years ago called From Boom to Bubble: How Finance Built the New Chicago. And in the book, I analyze what I call the financialization of urban development and urban redevelopment. And what I mean by this, and what I mean by the title of my presentation today, is that the urban built environment has increasingly become shaped by investors, brokers, advisors, and other actors in the financial sector who evaluate the performance of that built environment according to their own logics. Some cities also, some municipal governments also become active agents of financialization, although rarely under circumstances of their own choosing. And these interests, the interests of these agents, I'll argue, often conflict with the desires of preservationists to keep cultural assets occupied, in good repair, and economically viable. The book is also a case study of downtown Chicago, the Loop. And I analyze particularly commercial buildings, office, retail buildings, multifamily apartment buildings that were erected during the development boom of the 2000s, what I call the Millennial Boom. And during this time in Chicago, as in many other cities across the globe, the pace of new construction dissociated from population and employment growth and became more responsive to the desires of investors who were interested in putting up buildings very quickly and then trading these structures in a hunt for yield. The new speculative construction cannibalized tenants from older stock and made it even harder for older buildings to meet the investment benchmarks imposed on them by financial actors and to avoid conversion or demolition. I will use some examples from Chicago's Loop during the Millennial Boom to illustrate why preservationists, I believe, need to pay attention not only to historic buildings and their public and private financing sources, but also to the new build and their capital sources. So let's step back for a second and look at buildings in perhaps a different way than many of us are accustomed. In addition to being physical material structures with historic, aesthetic, functional, and environmental qualities, buildings are also financial commodities, much like stocks and bonds. And much like stocks and bonds, they're assets that generate income. They can be used as security for future borrowing, and they offer the potential for capital gains. But buildings are not natural-born investment vehicles. In fact, capital that's invested in the built environment in real estate is relatively illiquid, meaning that it is immobilized for long periods of time, and unlike a stock, can't be bought and sold with just a click of a mouse and at a price that everyone in the market can easily know. So buildings, as we know, are highly idiosyncratic. They're difficult to compare with each other and to other commodities. The quality of a high-rise office building, say in San Jose, is not publicly available knowledge, nor is it easily fathomed by investors, particularly if those investors happen to be in Memphis. Moreover, a building's value fluctuates depending upon its spatial context, like what a neighboring property owner will do, or whether the local government will invest or disinvest in nearby amenities or infrastructure. So all of these things make it difficult to speculate on a building's future value. Converting real property into a pure commodity, or what in the book I called assetization, and lowering the barriers to liquidity that would allow distant investors easy access to invest in that asset, or what I call financialization. These two things have been the big puzzles that real estate and financial professionals have tried to solve over the last 100 years. How do you turn an asset as locally embedded, opaque, illiquid, and slow turnover as a building into a commodity that is global, liquid, transparent, and speedily transacted? Well, one way is through innovation in financial instrumentation. So even if we go back to the 1920s, we see merchant banks and bond houses issuing securities backed by the commercial buildings whose construction they were financing, and they sold these bonds to high net worth individuals and to other banks. And the bonds that they sold underwrote the construction of most of the skyscrapers in the United States during the 1920s. It also led, many believe, to overbuilding and to widespread vacancies that were part of the Great Depression. In the 1960s, we see new forms of syndication that allowed corporations to create their own subsidiaries that could own real estate, both the real estate that they occupied and other investment properties, to receive more favorable tax treatment. And during the savings and loan crisis of the 1980s, we see the federal government creating the Resolution Trust Corporation to help out insolvent banks by turning the bank's real estate holdings into asset-backed securities, also called derivatives or structured finance instruments. So derivatives, or securities that are backed by assets or mortgages, like commercial mortgage-backed securities that were popular in the 2000s, what these do is separate the debt repayment streams of a building from the underlying asset. They pool these streams with comparable ones and repackage all these different streams as bonds, selling off the rights to different risk tranches to different kinds of investors. From a liquidity perspective, it's much easier to purchase a share of a pooled income stream that has been abstracted to a rating than to try to get into or buy an individual building. So what these mortgage-backed securities do is they provide this kind of ease of access. And in doing so, securitization broadens the base of possible investors and expands the volume of funds that are available to invest in real estate and to build new buildings, to acquire existing ones. They also strip buildings of their distinctive quirks and idiosyncrasies. They release them from their spatial contexts. It doesn't really matter if a mortgage that is put into this blender that slices and dices them and creates these bonds, doesn't really matter if they're in San Jose or in Memphis. So yeah, there's this form of abstraction that also takes place in constructing these derivatives or securities, and they help to speed the pace of transactions. And so that's what we see taking place in the 2000s, as we see the growth in asset-backed securities. And asset-backed securities in this slide are in the sort of, I guess I would call it the maroon color, the maroon layer or sediment here. So you see that sort of starting in around 2003, a real increase in the volume of asset-backed securities, as well as other kinds of financial commodities that were, as I say in the book, sort of hastening the turnover of capital in the built environment. So these instruments, it's not just the introduction of a new instrument that can cause more capital to flow into real estate. There has to be demand to buy those shares, as well as the markets to circulate these new instruments. But historically, when we've seen the timing of a new instrument coincide with relatively low rates of return in alternative asset classes like stocks and bonds or tech, as well as legal institutional reforms at the national level, like the tearing down of the walls that were erected during the New Deal that separated banking from investment, which took place in the 1990s, then capital has tended to switch from other sectors of the economy into real estate. Keynes noticed this. He wasn't really looking at real estate at the time that he was writing, but he discussed how financial speculation could convert booms into bubbles, hyperextending business cycles so that they would potentially skip a downturn. And I also found in my own research that instruments, looking historically, the introduction of new financial instruments tends to amplify property markets' ups and downs and prevent the adjustment of prices that might otherwise limit the oversupply of new buildings. So basically, I'm tying the introduction of new financial instruments to overbuilding, particularly in the commercial property market. So booms and bubbles are also a time when we see what Schumpeter called creative destruction, the idea that in order to invent new commodities, capitalism has to render older ones obsolete and destroy them. So periods of financial innovation and new construction tend to co-occur in time with intense periods of annihilation, meaning in the property markets, demolition of buildings and the destruction of previous land uses. It's not just because new buildings can replace older ones because they're sort of built on their bones, you know, the sort of classic redevelopment experience, but because when you erect speculative buildings, particularly in a low growth or a no growth environment, you're going to set off a chain reaction or a sequence of relocations where once the new space is claimed by a first mover, which then leaves another vacant unit or vacant space behind, which is claimed by a second entity who leaves their vacant space behind, and so on and so forth. So you see the business relocation activity is often directed toward new buildings and hotspots of new construction and away from older structures and older submarkets. And so at the bottom of these chains of relocations will lie marginally older buildings, which slip down the status hierarchy by virtue of their vacancy or deferred maintenance or having smaller or poorer tenants. In effect, they're made obsolete. They're obsoleted and become threatened. So I'm going to turn now to my case study of Chicago. And even if you've never been there, it's possible that you know a little something about the city because it's such a self-conscious and frequently analyzed metropolis. It's been the scholarly focus of attempts to understand everything from neighborhood succession, like with the Chicago School in the 1920s, to racial change, to urban politics and globalization. The city's popularity among social scientists is in part a function of its geography. The city's development on a relatively flat and featureless plain allowed economic, political, and social factors to dictate its future form, obstructed by few topographical features other than, as you see, Lake Michigan to the east or the Chicago River. And much like the city itself, the Loop, as the CBD is commonly known, has been the prototype for different theoretical models to describe and explain the complexities of urban development. It's the bullseye and the concentric ring model developed by the Chicago School in the 1920s, the command center of models for urban politics, and the nucleus for other economic models of urban density and land values. Well, in the 2000s, or in 2000, the year 2000, the Chicago region was one of only two major office markets in the United States that were still core dominated, the other one being New York City. So that means more than 50% of the regional office market, or the office space in the Chicago area, was concentrated downtown. And in 2000, Mayor Richard M. Daley, who'd been elected in 1989, he inherited a loop that he still thought had problems. And so, there had been the sort of steady flow of businesses out of the CBD into the suburbs or elsewhere in the country or overseas. And Daley, when he took office, vowed to make the downtown a 24/7 destination with amenities like public parks. He eventually built Millennium Park, as well as new residential and retail construction. And at the time he took the office, the loop was ripe for development and redevelopment. Zoning and preservation regulations permitted redevelopment of all but a handful of areas, such as the Michigan Avenue street wall, which was protected by a landmark designation and preservation ordinance. But the submarkets on the fringe of the historic core, which you can see in the slide on the right, are sort of bracketed by the Chicago River to the north, and that's the Dan Ryan Expressway to the west. But that area was, the sort of areas surrounding that were identified as a kind of value moat, if you will, or growth zones, as the city designated them, given that they were less dense and they still hosted a lot of industrial space and rail yards and warehouses. So these were areas that the mayor and the planning department identified as being sort of as ripe for redevelopment. And after a rough down cycle in the early to mid 1990s, when see-through buildings, these are sort of vacant new construction buildings, and developer bankruptcies were a familiar occurrence, national and regional developers came to Chicago and produced scores of new office towers, as well as new multifamily high-rise buildings, most in these submarkets on the fringe of the historic loop, on the north side and west of the loop. And you can see some of the buildings on the left side of the slide. The speed at which these skyscrapers were erected was breathtaking, even if the designs weren't. Most were built in that sort of contemporary steel and green glass style that critics considered to be attractive, functional, and understated, much like the city itself. But after this millennial boom, so about 10 years of intense new construction downtown, Chicago certainly felt like a more modern city architecturally, with over 50% of the downtown stock having been built after 1980. The boom had observers like myself kind of scratching their heads, because at the same time that we were seeing all these new buildings put up, we were reading reports and analyzing data that was showing that the city itself, at least economically and population-wise, wasn't doing so well. So even though the early buildings that were erected in the late 1990s and early 2000s were commissions, meaning that they had guaranteed occupancy, most of the other buildings after that were spec. They did not have tenants before they were erected. So there were a lot of us who were wondering, why exactly were all of these buildings going up and going up so quickly? Well, it wasn't employment growth. between 1999 and 2009, the sort of the big building boom, Chicago's downtown added about 15% new square footage to its the office stock that existed in 2000 or 1999 rather. So added about 15% new stock, which is around average for the largest office markets in the United States at the time. But by the end of the boom, and even before the worst of the bust, there were approximately 8.3% fewer office-using jobs located there. The failure of many tech startups and layoffs at large law firms and ad agencies that took place during the recession of 2001. So you see the red and the green lines going down a little bit after in 2001. Combined with the secular trend of declining space per employee, left millions of square feet of subleasable space downtown. Moreover, rents were slow to register this interest. Vacancy rates swung up to about 20%, but that didn't mean that the new buildings that were erected were empty. On the contrary, vacancy rates in the new buildings were quite low, and these were, as I said, spec buildings. I analyzed Dun & Bradstreet establishment data, so I was looking at firm data, and found that the tenants of these new towers were overwhelmingly businesses that had already been in the loop. In many cases, like the proverbial chicken, they had just crossed the road. Moreover, the majority of the businesses who occupied space in these new steel and green glass towers, the ones that had undertaken these micro moves, they were not growing. So when they moved, they tended to take up less space than they released in their older buildings. So they left large vacancies in their wake. My interviews with brokers suggested that tenants moved because they wanted the new build. They wanted higher performing buildings, ones with open floor plans, more exterior offices, and large blocks of contiguous space uninterrupted by columns or elevators. Brokers were quick to point out that they wanted a more modern aesthetic. So, less of this is a lobby from a 1980s building downtown, and more of this. So these are what I call the design motives for relocation, or the obsolescence argument, that these older buildings were obsolete, so they had to move to the new build. They're difficult to validate with quantitative data, like I was able to do for the other potential explanations for why new buildings were going up. But I will say that few of the tenants that I interviewed had initiated the search for new premises on themselves. Most of them were sort of guided to the new construction by brokers, and few had increased their productivity as a result of their moves to more modern buildings, either by reducing the rents or operating costs, or by raising the ability to raise or increase the revenues. So what I believe we were witnessing during this construction boom had less to do with the utility tenants were gaining from new construction, and more to do with the amount of cheap, freely flowing capital that was rushing into Chicago as a result of the sale of new financial instruments, such as commercial mortgage-backed securities. So most of us associate places like New York City and the City of London with the financial industry. But these places, even though they're the major trading centers for securities, are merely the last links in a chain that standardizes and moves capital from other, more diverse settings to aggregators in these metropoles. Indeed, Chicago and cities like Atlanta, Washington, D.C., Houston, Philadelphia were the strongest markets for originating CMBS, commercial mortgage-backed security loans. So Chicago was viewed as a stable and reasonably priced city for making these loans. It was viewed as being protected by the Daley administration, who was very supportive of new construction. Approximately 160 loans valued at close to $10 billion were made on properties in the Loop between 1998 and 2009. and they were converted into commercial mortgage-backed securities, so about $10 billion worth. Some of these loans were made for new construction, and others went to purchasing existing real estate. About 85% of all the buildings downtown sold at least once during the 10-year boom. As almost overnight, Chicago went from a city of one-off sales to a city where investors could swoop in and pick up multi-property portfolios. Chicago's famous office buildings, hotels, and retail spaces were purchased or refinanced with CMBS loans, selling for prices that bore scant relation to the condition of the underlying asset or the income that that asset was generating. Record sale prices signaled to developers that they should keep building, and so did the purchase of these massive loans that they were using to erect and acquire buildings. So when I asked developers why they were adding more space, why they were putting up these spec buildings despite the kind of depressing economic news, the developers I interviewed told me that they were watching the CMBS yields closely for signals about when it was the right time to build. My questions about softening employment or the rising vacancy rates were typically brushed off. Lenders, too, seemed very blasé about flattening demand. One said, if the question to the answer is, can we sell the loan? If the question to the answer, can we sell the loan, was yes, well, then we made the loan. So to keep up with demand for these securities, banks made more loans. And because CMBS lenders tend to cherry pick projects with more impressive income streams, this spurned smaller and medium-sized regional banks, like the ones I have listed here, barreled their way into construction. So they were making many more construction loans than they had in the previous 10 years. They loosened their underwriting requirements, often funding what ended up being kind of dubious projects. One interview subject, a developer, said that he would have jumped out, in 2007, he would have jumped out of a plane without a parachute. So confident was he that investors would buy up whatever he put up and that he'd be able to find financing for his projects. So how did this influx of cheap capital, cheap available capital, affect historic buildings? First of all, with all of these large-scale spec buildings going up that needed to be occupied, brokers went big game hunting and helped relocate anchor tenants from slightly older structures. The number of new office leases signed per year more than doubled between 1998 and 2008. 10 of the 20 largest law firms in Chicago relocated to new quarters, and the same was true a lot of the ad agencies and financial offices, financial corporations. Many of the older buildings, then stigmatized as obsolete, instead increased their vacancy and fell into decline. If they happened to be sold to new owners with deep pockets and manageable debt, they could get some love. So a handful of recent skyscrapers with name brands and architectural pedigrees, like this building here. This is a building designed by Philip Johnson, built in 1987, 190 South LaSalle. They underwent multi-million-dollar renovations. Even though these buildings lost major tenants to the new construction, becoming in some cases, like 190 South LaSalle, becoming up to 60% vacant, the new owners decided to undertake major modernization schemes, including new lobbies, new elevator systems, even fitness centers and private clubs, because they were trying to compete with the new build. However, even the new owners of these retrofitted skyscrapers admitted that the renovations would not translate into rent premiums and that they would probably only, and I quote, be able to compete with the low Class A or Class Bs. So they had to take a kind of haircut in terms of their rents. For Class C office buildings, considered architecturally distinguished, and in Chicago that means that you have some connection to either Daniel Burnham or Louis Sullivan, a more common strategy was to convert them into residential condos, apartments, dormitories, hotels. The developers that were drawn to these projects were generally smaller regional ones, and they often had a tough time getting the financing that seemed to flow so easily to new construction. Lenders were more circumspect about adaptive reuse projects than they were for new construction, and they required things like padded reserve funds and higher debt coverage ratios for these projects. It's partly because they were expensive to convert. The average acquisition costs for B and C office buildings increased from about $30 a square foot in 1998 to $125 in 2008, not including the expense of buying tenants out from their leases. Moreover, before the boom, several of these buildings had been recommended for landmark status, but City Council had never passed the requisite ordinance to protect them, so they were in a kind of limbo status in terms of redevelopment. However, the City of Chicago, under Mayor Daley, had a strong interest in these adaptive reuse projects. Residential conversions of Class C office buildings would eliminate some of the excess capacity weighing down the office market, while allowing the city to preserve the ornamented facades of buildings that gestured at the Loop's history and gave the downtown an identity, a visual diversity, and a texture. Destroying the surplus allowed the city to continue to permit the construction of high-end office towers that could accommodate corporate headquarters and business service functions of the global city that Chicago wanted to become. The Daley administration never announced a comprehensive initiative to adapt surplus offices to residential uses, unlike New York City's Lower Manhattan Revitalization Plan, which offered a package of zoning changes, financial incentives, and rebates on utility costs to encourage similar kinds of conversions. Moreover, the city was inconsistently supportive of conversions, as it tried to always reconcile the divergent interests of residential and office tenants, developers, and building owners. As with many of its other urban development policies, it moved forward in an uncoordinated, mostly reactive manner, so that when one of the buildings that was on this list of sort of pending landmarks was suddenly demolished in 1996, the city jumped into action and decided to protect the others. So over half of Chicago's 277 landmark designations occurred during this period. In exchange for limiting owners' ability to demolish their buildings, however, the city twisted the arm of Cook County, the county that includes Chicago, to offer property tax abatements to even non-landmark buildings designated as historic. The new Class L property tax abatements created an incentive for redevelopment, but didn't protect a building's prior use. So in almost all of the cases, the property owners that took advantage of this abatement for historic properties converted their offices, their Class B and C office buildings, to market rate residential uses. And most took advantage of the state and federal historic tax credits as well. The city's other strategy for encouraging conversions was a municipal financing tool that was a form of debt securitization that I was discussing earlier in the context of these asset-backed securities. The Daley administration took advantage of escalating property values to borrow heavily, build, and then sell off streams of future property tax revenues through an instrument called tax increment financing. At the start of the boom, the downtown was covered in 8 different TIF districts, as you can see from the slide, and the city was generating almost $1 billion annually, which was sort of creating a little slush fund for redevelopment. So the city could use the incentive freely, and it did. It used TIF to finance not only the new construction on the fringe of the Loop, but also adaptive reuse projects, mostly Class C conversions. And then I think most egregiously used TIF to pay for the relocation expenses of headquarters that were located in one part, typically an older building, used TIF to help subsidize the build out and moving expenses for headquarters if they moved to a newer building in the city. So they were essentially sort of creating a market for these relocations. The preservation community mostly lauded the use of TIF, the Class L abatements, and the city's encouragement of these Class C office conversions, even though small businesses were displaced and many had to leave the loop. Many of the buildings that probably would have been demolished during previous booms, like they were in the 1980s, when even buildings designed by beloved architects like Louis Sullivan were flattened to make way for surface parking lots and new office towers. In contrast, instances of demolitions downtown were relatively rare during this millennial boom. Approximately 90 demolition permits were issued, most for smaller structures. Nonetheless, the city habitually yielded to pressure from developers, as evidenced by the 25 years it took to pass the ordinance designating the Michigan Avenue Landmark District, or by the fact that even 4% of the buildings that were on the Chicago Historic Resources Survey, which is a color-coded priority system for the city's historic inventory, were demolished. Most of the buildings that were torn down were from the booms of the 1980s and the 1960s, like the U.S. Gypsum building that was built in 1963. But here's an image of an older building, the former home of the Chicago Mercantile Exchange, which was built in 1927. It was a 17-story Beaux-Arts building that was one of the major casualties of this boom. The building had, as you can see, large arched windows, and what you can't see are these great stone panels that had carvings depicting hens and eggs and merchants on its limestone exterior. The new owner saw little reason to maintain the building, which was notably not landmarked and not Chicago School, and in 2003 the building was razed. The ease with which the developer was able to obtain a demolition permit prompted a series of passionate protests in period dress, the result of which was an ordinance requiring the city to wait 90 days from announcing a demolition permit to issuing it. In addition to those buildings that were demolished, I think the ones that were most damaged by the finance-led overbuilding that I was discussing earlier were those slightly older Class A and B buildings that were built during the 1960s and 80s that were not renovated. So here you see iconic modernist office building, the Smurfit Stone building with its diamond top, or the IBM building. And these were, recent past modernist buildings that were approaching or nearing, the end of their 30-year life cycle, as many believe there is for office buildings. As one developer told me, they were fully depreciated but not yet appreciated. So when they were worth less than they were purchased for and owners could not refinance their mortgages, these buildings became zombies, occupied and alive, but just barely. If they could not secure the label of vintage or modernist or lacked the name appeal of a famous architect, these recent past buildings hemorrhaged tenants and spiraled downwards. In the words of one broker, they, quote, sucked wind after their anchor tenants moved to new buildings and could not be backfilled by new businesses. These buildings were difficult to convert to residential uses, with floor plans and finishes that did not lend themselves to adaptive reuse. One developer poked fun at a 1980s skyscraper for giving off a strong smell of the 1980s. He said, it was that dark ruby red or cranberry carpet and dark walnut on walnut with more walnut. So there was a lot of making fun of the 1980s that I encountered when I was doing these interviews. While vintage buildings were beloved and maintained, and they maintained their values better over time, the sort of more recent past construction was stigmatized as obsolete and declined in value. Yet even these 1980s Class B buildings that were sold during the boom, that some of these buildings that were built in the 1980s still were part of this kind of acquisitions, this transaction frenzy, this sort of buying and selling of buildings that took place in the 2000s, and many of them were actually purchased with the CMBS financing. So this means that they were appraised at values that bore little resemblance to the incomes that the buildings were generating. and these incomes were not sufficient to pay off the debt that their owners went into to purchase them in the first place. So the owners struggled with vacancies that threatened their already precarious financial arrangements. Securitized loans and Class B buildings, in fact, were the first to experience financial distress and then foreclosure when the global financial crisis finally hit in about 2008. Their capital structures were so complicated that in some cases, owners just gave up on them. They sent the building's keys back to their lenders in a phenomenon known as jingle mail. Even in the recovery after the global financial crisis and before the pandemic, owners of these Class B buildings have struggled to shake off the boom era excesses, continuing to miss payments and constantly sort of threatening, with banks threatening delinquency. Many believe that it is these buildings, the Class B buildings from the previous booms of the 80s and 60s, that are sitting ducks for demolition when the next tidal wave of capital hits. So I've tried to show how preservation policies need to contend with these kinds of dynamics, the dynamics that are propelling both new construction and demolition, and in particular how financial markets stimulate the sort of frenzied creation of new assets and the removal of those that are devalued. In the face of finance-driven construction booms and bubbles, historic preservation efforts may be small remedies occurring at the tail end of a chain of vacancies motivated by factors over which local advocates and planners have little control and often little understanding, which is why I would urge preservation advocates, teachers of historic preservation and students to expand their vision beyond site fights over individual buildings and over esteemed architects to learn about the drivers of new construction that may result in certain submarkets and structures becoming threatened in the first place. I would urge you all to encourage your students to take an interest not only in the older buildings, but in the new build, to learn the basics of development finance at the project level and to be able to analyze investment and occupancy trends at the scale of the market. This might also help to not only anticipate the next vulnerable building or submarket, but also to help us all think through creative policy strategies and responses that might connect contemporary development dynamics to both the past and to the future. So thank you very much. I'll end right here.
Thank you so much, Rachel. Really appreciate all that you had to say on this topic. I will just close up this wonderful presentation from Rachel Weber in time to say that there is going to be an opportunity for continued discussion and for some question and answer. We're going to have all three of our speakers on one call on October 26th at 5 p.m. Eastern Time. And if you would like to attend, we invite you to sign up for that webinar at ncpe.us, ncpe.us, and to email any questions you have in advance. Email those to ncpeconference@gmail.com by October 23rd. That's hopefully you're seeing on your screen. Thank you again so much, Dr. Weber, and I hope that anybody who is tuning in and listening to these videos knows that you should also click on the next two parts of this discussion of this series. The next video will be a presentation from Don Carter, and then part 3 will be a discussion from Ray Gaskell. So please stay tuned for the additional sections.